Time to look at the bottom line. Oh, who am I kidding? You always are looking at the bottom line. How much is an input? How much are you going to sell it for? Is constantly on the mind of those in agriculture and in business. No different right now as commodity prices are lower. There appears to be trade troubles, always tariffs being talked about. What's the impact there for the farmer? What are you looking at right now? We're going to talk with Charles Barron from Farmers Business Network, revisit with him about what their services are and just kind of some of the models, how they're using some computers to kind of help you out and figure out what is working, what is a plan of action, and what's the landscape right now? We're going to talk heavy in trade. We may go off the rails just a tiny bit. I just get a little obsessed talking about the topic and certain things. So Charles is going to discuss AI. We're going to talk about federal interest, the Fed rate, the interest rate. What's that mean? What happens if it's lower, a quarter or a half point? What's that mean? We'll talk about land purchases, equipment purchases. What is happening right now? Details over talk. What matters when it comes to trade? That's what is the main focus of today's episode. And a reminder, get signed up for our Market Insider newsletter. We send that out every Monday. We have updates, give you previews of what's coming ahead in this podcast or else on the show. We got a big party coming at the end of August. We're writing about it right now in the Market Insider newsletter. Subscribe at markettomarket.org. I'm Paul Yeager, by the way. Here is this week's installment of the MTOM podcast. Recap again for us exactly what FBN is.
So FBN is a network of producers online, and it allows farmers to come buy inputs, get loans, market their grain, access sustainability premiums and services. We have grain marketing advisory programs. You can buy in the inputs. You can buy products, including everything from crop protection to seeds, certain types of fertilizers, livestock feed, livestock supplies, and animal health products. So we really try and serve the whole farm's need to reduce their operating costs by making their purchasing more efficient, and then improve the value of their yields by giving them better market intelligence, giving them agronomic insights, and using things like artificial intelligence to help their decision making, and then access worlds of premiums through things like sustainability and regenerative agriculture.
Well, let's go back to the very first answer you gave, and let's see if you give the same answer to this question. But how would you state the state of the farm economy right now?
I think it just continues to have a lot of uncertainty. This has been a tough year. I think last year was a tough year, and this year probably just has more embedded uncertainty in it as producers are going into the year. I think there's been moments where farmers have tried to readjust to a new normal, and then I think the market got a bit of a shock in the last week. With some what is a very good crop. The irony here is we've planted a very big and now what looks like a very healthy crop in corn, and that's put more pressure on prices. So I think you see a lot of farmers with a fair amount of uncertainty. We see plenty of farmers who are very confident, or just like this is normal. We go through these cycles. You got to buckle down. But it's certainly been a year that's caused a lot of stress on the farm.
Well, I actually wrote that down to talk about the size of the crop. Do you think that are there producers out there that you talk with thinking they're going to be able to produce their way out of lower prices?
Well, that's the interesting dynamic. So in the run up to the year, more farmers switched in March and April. We saw a late shift into corn. And so a lot of farmers reacted to prices at that moment by chasing corn. That corn crop, we had a pretty smooth and early planting. We have not had a lot of extreme weather or major drought events, throughout the country. And we've had a lot of heat and a decent amount of moisture. So right now, the crop looks quite healthy and quite strong. And so there was just some numbers that were going out on social media a week ago, which caused a bit of an uproar.
You can say that again.
Right? So national predictions of a 187 bushel yield. We just came out with our own planted acres estimate the week before, where FBN surveys our producers, and we estimated a 95 million acre corn number. So that confirmed, a larger shift to corn, not quite as big as what some people were expecting. Now, are you going to truly get a 187 bushels? That would be a massive jump. But there just haven't been all the interruptions that you normally see, or sort of some of the big regional disruptions. We haven't had a big derecho. We haven't had other impacts that show up this year. Obviously, there's been rain, there's been flooding in various pockets, but by and large, it's been a pretty good year.
You're kind of the gateway where you are physically located to what was kind of dry, did get some rain, and I'm a little further east. Go out to Indiana, Ohio, and they'll tell you different stories about how wet. Then you start looking at these uh, pollination issue questions that emerge. When all of that is factored in, how does an AI computer help me make sense of that versus my emotion of, I know it's dry or I know it's wet?
Right. Um, well, there's various signals that you have to react to. But I think when you look at that, you can always just compare what you're seeing in the current crop to your historical weather, and it's useful to go back to your own farm's historical weather, your historical trend lines, and that gives you a your gut check on your gut perception. Um, but what AI can really help do is when farmers are faced with specific issues, related to the market or related to, some pest or disease issue, AI is sort of like an agronomist or an advisor that you can tap into and that can provide you, a synthesis and a decision-making process to go through. And so we've actually started experimenting this year with an AI grain marketing advisor. So it allows farmers to come in at any location and they can tell us where they are, or it knows where they are, and then it finds all the regional prices for them. And we're experimenting with some interactivity there about how farmers can get specific local marketing advice based on the local conditions. And then ultimately, what we want to do is be able to connect that kind of grain market intelligence to your field specific intelligence, which is being monitored through either satellite imagery or your machinery, to give you a very, very personalized, comprehensive plan, both agronomically and financially, for the farm on an ongoing basis.
We know that we guessed, I should say, hypothesized that was happening out there. So you're saying the a little bit of the quiet part out loud that yes, it's being out there, and a farmer needs to know, just like those high yield estimates, they need to know that there are people thinking this and this is what's going on. I think that just helps a producer make probably better decisions. Is that right?
Yeah, well, in our context, that's always when we say we're working on that. That's a system or a product that a producer would use, right? So there may be grain traders out there who are using AI in different capacities. If they're looking at market estimates, the way FBN operates is it's a system for farmers. We're often an advisor to the farm when it comes to us being a grain marketing advisor. We do have an advisory program, or us providing agronomic advice. But really, that synthesis of putting all the different pieces of the farm system together into the decision making that a farm has to operate, that's what the farmer's doing on their own, and trying to piece that all together. And what AI is going to enable them to do is really to have an assistant in that, in the future, pulling all those different threads of local field specific intelligence, pest specific, or issues that might be popping up, everything from your soil sample to taking pictures of the diseases that are showing up in the field, to then what's going on in the market locally, nationally, et cetera, and helping you navigate that process.
We're also trying to navigate trade policy. It changes a lot. It changes quickly. You mentioned it off the top there when we talked in October, November. We we heard campaign promises. They've become reality for a lot of things. What has been the biggest trade headline you think farmers have had to navigate so far here in July of 25?
Oh, geez, there's been a lot. I think that the complex thing of trade with ag is it's so multi-sided. So it is impacting producers on their exports. It's impacting the end markets. It's impacting some of the downstream programs that were bringing premiums. So the EU, for example, has slowed down some of the appetite for premium programs that were driving premiums and sustainability premiums into the U.S. And then on the cost side, it has really, thrown, a lot of confusion, I would say, into the supply chain of major inputs. Certainly with fertilizers from Canada, but also in agrochemicals, which come very heavily from Asia, from China, from India. And really, the most challenging thing is uncertainty in that. It's one thing if we say, hey, there's a tariff, it's going to be 10%, it's going to be 25%, and that is stuck with, and that's going to be the plan for the next 4 years. I think most businesses can adapt to that and react to that. When there's an announcement that the tariff could be 27, 74, 90%, 100% plus, and then that goes away 2 weeks later, that is an incredibly difficult environment for us to manage a supply chain. When you have products, moving off boats or needing to have large procurement that needs to take place months and months and ahead, and then you have to be extremely careful and extremely cautious as to how you manage the inventory that exists in the United States that can be sold, and then what you're willing to commit to that could be coming from abroad in the next several months. So, just there's so many. We deal with Canada, we have Mexico, we have China, we have the EU. Ag is ag, and Iowa and Nebraska and Midwestern producers. We're selling in a global market, and so we're touching all these countries, whether it's Mexico, China, or Europe or beyond.
If there are reactions to be made, do you think that the market is reacting as harshly, as quickly, as the most volatile as it did in the beginning, or has the market kind of softened to its response when there's just a threat made?
I think I think the grain markets are probably digesting the information. They're a little more liquid, and there's probably more openness as to what's going on in those trades in terms of the information. In the supply chains that manufacturers or retailers like FBN have to deal with, the uncertainty is really the biggest challenge, because like I said, it is very hard to plan. If you think one day it's 27 and the next day it's 97 and the next day we're back to 10, and then if you bought something, by the time it shows up, that product, the tariff could go away completely, and now you're selling it, below what you actually acquired it for. So what we have seen is that initially, when the tariffs came out, we might have anticipated a steeper shock in prices that made their way to farmers on the input side. And I think what happened, in fact, is there was enough product sort of sitting in the United States when you talk about agrochemical or certain other inputs, that it didn't cause as steep of a price increase right off the bat as people may have estimated. But that's slowly started to work its way through. And as the product that's sitting here, gets sold and gets exhausted, then manufacturers and retailers are dealing with the very tricky problem of how much do you commit to bring in, and at what cost level, because you have all this uncertainty as to where these tariffs can land.
Are you getting the sense that businesses, let's talk suppliers specifically here, these middle that I'm picking up has some of the most headaches, are they much more cautious in their bookings of things and maybe just going what they used to always do at this time of year as a roadmap versus 27 to 72 to 150%?
Yeah, I mean, think when you saw the start of there's going to be a trade war, then what you saw manufacturers, retailers do was stock up. So you saw you saw a big increase in imports that happened in the run up in anticipation of the tariffs. Since that time, you saw a very steep drop off in the amount of imports that have taken place. Once the tariffs were formally announced, and now the tricky thing is going to be how to balance those two out. At what point does the supply sort of exhaust itself in the U.S. market to the point where you have to start replenishing it, and then as you're replenishing it, at what amount do you actually commit to? Because let's say you decided to buy your entire next year's worth of inventory the week that you thought the tariffs were going to be 134%. That would be completely disastrous if those tariffs then went away 6 months later. So that's the very, very tricky thing that people have to account for.
What is a bigger problem for supply chains? The volatility of the threat, or is it details? And when I say details, they don't have any details, and therefore it seems like it's frustrating.
Yeah, it's both, but it's really specifically the volatility, right? I think in essence, the market could react to whatever the number is, and the business environment will adjust. Now, that doesn't mean that that's going to be good for farmers, or that doesn't mean that that's going to be a good business environment if suddenly the cost of everything goes up 30%. But that certainty at least allows people to plan, and allows farmers to plan, allows people to adapt and change and make product decisions. But when things are just moving around a lot, that's the hardest. That's the hardest environment for companies and for farmers to react to.
Why then are businesses reacting if there's not been details? If it's just a threat?
Well, at a certain, you have to manage your risk, right? You have to take people at their word, and you have to assume that this is the envelope of risk that you might be exposed to, and so the cost of inaction, there could be some if you get caught on the wrong side of that, and the cost of too much action, you could get caught on the wrong side of that as well. So I think there's probably a little more understanding now than in the very early days of the trade war that things might not move as dramatically or in as big a swings as the threats, as people sort of adapt to the Trump negotiating style. But you still have to manage that risk, and you have to watch it very tightly, because it creates the most fundamental uncertainty for any importing business.
Do you think in 2 to 5 years, global trade's even going to matter to your businesses or your farmers that you work with?
I think absolutely. I mean, I think look at the bulk of agriculture. I mean, the U.S. Agriculture is one of the most important exporting industries for the United States. And you look across the ag sector, whether it's in beef, whether it's in pork, soybeans, we are in alfalfa, just throughout the system, throughout the United States. Exports are a huge part of our market. So we absolutely need, strong trading relationships, and strong market access. And I think that's one side, and then you really just need stability and predictability on the costs for the supply chain. Now, in some products, switching on a new country, like let's just say you wanted to switch from China to India, or China to domestic, right? Some of these things are very difficult to move. You talk about mining of raw technical ingredients, or mining of fertilizers. You talk about chemical manufacturing. Some of these are facilities that the United States just simply hasn't wanted to build, or hasn't enabled to be built, for decades. And so, even if there was a country who suddenly wanted to shift demand there, these are very long lead time pieces of industrial infrastructure that take many years to plan, finance, and build. So it's not simple for the world to adapt on a dime to some of these. Now, are there agronomic decisions that farmers can make around those? If those certain products become just continuously very high cost, sure. But we are still dealing with, that all said, with all the trade uncertainty that we've had in some product categories, like in chemical and crop protection, we're still dealing with historically very good prices. So even though our prices have gone up about 10, 15% or so since the start of the trade war, these are still much better prices than we were dealing with for farmers 2 years ago, 3 years ago, when you had even more uncertainty in the supply chain during COVID. So for example, glyphosate, which is ubiquitous agrochemical, price has gone up in our system about 15% since the trade war or so. But it's still $14 or $13 a gallon, and it was $72 a gallon in its peak in 2022, right? So we're still in a historically better environment on certain inputs. Certain inputs like seed are not really tied to tariffs and trade, and so that is really decoupled. And really, seed prices have just continued to rise year over year over year, for the last many years, because of the trait licensing programs that seed manufacturers deploy. So that one you really can't say trade is causing the issue on input costs. That's really more the domestic ag manufacturing dynamics, or the dynamics of those seed companies. And then the question is, okay, well, what's going to be my corn price, and what's my crop going to be worth? Can I afford those inputs? So it's specific in each different part of ag, that the farmer has to manage. But ultimately, strong markets are going to create better prices, and that's going to make it easier for farmers to manage this uncertainty.
But I hear we need to take care we can take care of a lot of our domestic produced commodities here, and we don't need to worry about a trade partner. Is that something that can we chew through all the corn and all the beans and all the cotton and all the wheat that we produce and just take care of it here and not have to worry about an export?
There's a lot to work through there. You're starting to talk about 20 to 30% of some of the major commodity crops. So I don't know that we have an immediate offtake. And if you did, and suddenly 20% of the market disappeared, you'd have an immediate collapse in the price, right?
You would, but that is some of the sentiment that's out there. And I think even some policymakers who think we don't need export countries, let's just take care of it ourselves.
Yeah. Uh, we'll have to invent a lot of new uses. I mean, don't short the
Right?
market on that. When something becomes very cheap, people figure out how to use it. But the immediate term, distress that would cause, if you suddenly had a quarter of the corn market disappear, whether through export or other, ethanol regulations, or a third of the bean market disappear, then you're talking about, a decrease of, 30% or more in price to a typical farm's income. And right now the farm absolutely can't sustain that.
What happens if then, okay, 30% goes away of the export, acres get flipped to something else, right? I mean, they're going to have to put those acres into use because it's the bank's not allowing them to let them just sit fallow for a year.
It starts getting very complicated at that point. Yeah. It's hard to fully envision that scenario, but that becomes very difficult for folks to manage, because you're either gonna we're gonna have to come up with conservation programs or other things that would cover that, but that becomes a very difficult situation for a lot of farms to manage.
How does a farm manage then watching trade negotiations? And is there a specific country? You've already mentioned EU, India, and China. Are those kind of the big three for agriculture right now in your
Uh,
mind?
well, the big ones for agriculture: China, Canada, Mexico, and the EU. And Mexico is a massive export partner for corn. Canada is a massive import partner for fertilizer, so it's really critical for our fertilizer supply. So if we're putting a major tariff on Canadian imports, that can have a very sharp impact on fertilizer prices. And then China, is pork, it's soybeans, it's corn to a lesser extent, and then it's the import of products that we get from China, which are quite important to the agrochemical supply chain. So those are the big ones in our bilateral.
Does but does agriculture lead in those bilateral discussions? I mean, you don't hear agriculture. We do in what you and I talk about on a
Yeah,
regular basis, but I don't see it on national news as much about the agriculture side. It's about drugs, it's about lumber, it's about maple syrup or whiskey. It's not necessarily the ag product, but ag is a huge part of this discussion, right?
ag is a major part, and I think it is features very prominently because ag is also where other countries retaliate against. Ag is a politically sensitive part of the economy, and so it's one that other countries can react to in a very specific way, which is typically what you end up seeing.
All right, let's shift to interest rates. Let's get more political, shall we? What happens to the farmer? I mean, the president keeps calling for lower interest rates. Then there's the Wall Street doesn't respond the way he wants, or there's models that say if you do this, this happens. What happens if there's a half a point cut in interest rates in agriculture? What's that mean?
It'd be very helpful. So cost of financing land right now is historically expensive. Certainly a major run up from where we were, for the last 10 years, when you had rates in the as low as single digit, 1 to 2% interest rates on 30-year loans in 2021 and 2020, which is obviously was a COVID reaction. But then they sort of stabilized in the 2 to 4% range. Now you're seeing interest rates in the high fives to 8% for land, and farmers are not this year was not uncommon for farmers to have operating loans of 11%. So that gets quite taxing on a farm. you layer that on top of these higher input costs and lower prices, and it's just more, more systemic stress on the farm. So lower interest rates will have a very, very immediate and positive impact for farmers. It's going to, number one, it's going to allow land to get refinanced that had been purchased in the last few years. Number two, it's going to immediately, lower the operating costs and the note expense of most farms, and that's going to filter all the way through the system.
Let's stick with land then in that discussion for a moment. How many farmers are actually using the bank to buy land? Because we hear anecdotally, nah, that's not happening. On the majority of the land is being paid for in cash.
Oh no, a lot of land is financed on new purchases, and so FBN is a major lender for ag real estate. Certainly volumes of real estate loans and real estate refinancing, went down pretty sharply as interest rates rose. Specifically refinancing, because basically everybody refinanced when you had rates, the 1 to 3% range. It was just a historically good opportunity. New purchases slowed a bit, but farmers are still acquiring land, and a lot of farmers are, acquiring with the mentality of it's better to get it when you can and hold it, and if you can make the economics pencil today, then absolutely get it, and you'll catch it on the other side if rates come down, and you can refinance.
So you're getting a sense that is it half of your customers are using financing to make land purchases?
Oh well, 100% of our customers are
Okay.
when they're purchasing, because that's the business that, in our side is the lending, but yeah. So I think we have absolutely seen a decrease in the total volume of real estate purchases that's taken place or in refinancing, but through the last 2 or 3 years, the demand has actually held fairly steady. You haven't seen it grow, but it's held fairly steady. Whereas in the preceding year, preceding couple of years, you saw demand just skyrocket as every farm wanted to refinance every parcel that they had.
Demand for refinancing, you're saying, is
Yeah,
skyrocketing.
yeah.
Now, okay. I thought maybe you were discussing demand on farmland, because are you hearing, seeing, experiencing still a strong demand and high prices for land at sales, or has that high price
It's
ship
it's
sailed
it's
for
steady.
now?
It's steady. I would say it's like we haven't seen a massive decrease in the volume of new purchases. You're sort of, if there's land available, farmers will find a way to purchase it and sort of justify the purchase in this environment if they see a path to rates being lower in the future, certainly.
So steady, at least,
Yeah,
to not declining.
yeah.
So does that mean then it's not, the interest rate could stay where it's at or even go up, and there would still be purchases made? They'd be more painful, of course.
I think we see as a function of the interest rate, so every quarter point or, half point the interest rate goes up, we see a decrease in total loan volumes or total, a volume of new purchases that takes place. That said, we have sort of been able to hold the volume of those loans that we've been seeing and getting requests for in the last couple of years. So the overall demand may have come down slightly. Our business has been very steady and very stable throughout this. But if rates come down, you will absolutely see lots of land come on the market and lots of new purchasers enter, for those sales.
Okay, do the corporate thing. Put the pin in the land when I ask this next question. If a farmer's not making purchase on a land, are
Yeah.
they sacrificing equipment, new or used, or other expenses that could be held to respond to the other higher rate they're having to pay on that land?
Yeah, equipment is one that you've seen, a very dramatic cost increase on in the last 2 years. Um, I think equipment is probably the one that gets delayed on the new purchases, but the used equipment prices have been quite high in the last year. I think that's come down a bit, but I think demand on new equipment is probably one of the first places that farmers start to question.
And do you buy into the theory of when you see used equipment outpace new equipment, that's not necessarily a great sign?
It's a sign of It certainly is a sign of there's more distress out there, and there is, and I think that's very clear. Is like you just are going to have more farms with distressed financials, this year and going into next year. If we're going to have continue to stay in a very low commodity price environment, that's going to continue. What's going to provide relief on that? Obviously, interest rates and interest rates coming down will provide relief, but obviously, the most important thing is fundamentally stronger prices for the crop.
Isn't there a concern, though, if a farmer has more money in a pocket because of lower interest rate, they're going to push the demand for something else, therefore inflating prices because demand is strong?
I mean, that can happen in real estate, but it's really a question of does the does that payment, can that payment be supported by the productivity of that land? Everybody's got to run that equation. I don't think people are going to get totally upside down, but farmers tend to also have a pretty long term view, and they think, okay, how long is $4 corn going to last? And if we get back to mid fours, fives, et cetera, and you have a moment to take land and lock in a good interest rate, that may not be a bad equation, even if there's a year or two of pain.
What's the headline when we talk in 10 to 11 months from now, Charles?
um, that's gonna. I hope the headline is sort of a stabilization of the trade situation. I think that's probably the most important thing. If you said, of everything that's taking place, if simply we can get to some stability and just consistency that we can operate in for a year or two, ideally more, but ideally 4 years. But if we can get a year of sort of smooth water in terms of just not having massive shocks on those relationships, I think the market will be able to adapt to a new reality fairly quickly.
You really speak like a farmer because that's very optimistic. It doesn't seem that there has been much to make us think that this will be calm in the
Yeah.
way, if past history is any indication.
Yeah, it depends how aggressively the U.S. is really goes after these bilateral relationships. How quickly those other countries come to the table. I was with farmers yesterday, and they were surprisingly optimistic. There's some very big, very sophisticated operations, and they were very optimistic. And I was with some folks involved in international negotiations, and they said a lot of countries are starting to come to the table fairly quickly. Who are major, who could be bigger export partners. So you might see some new markets open up, but the really big ones that drive the market, China, Mexico, Canada, the EU, those are the most important, and so we need some stability in those relationships.
Charles, good to talk to you again. I appreciate it. Thanks for enlightening me on all my crazy questions.
Great to be with you.
For executive producer David Miller, I'm Paul Yeager, your producer and editor. Audio assistance comes in the form of David Feingold, Reed Denker, Kevin Rivers, Julie Knutson, Neil Kyer, and their boss, Sean Ingracia. Thank you, and we'll see you next time.